imagine a business that's making over $1 million on paper this year. But then they just close their doors on a random Tuesday because they literally cannot make payroll.
Yeah, which sounds crazy. But for the operators of childcare centers, I mean, this isn't just some abstract worst-case hypothetical. It's a daily looming reality.
Right. Because when you think of a childcare center, you probably picture like brightly colored playgrounds, finger painting stations, little cubbies with names on them.
Oh, absolutely. It feels very wholesome, very straightforward.
Exactly. But if you actually pull back the curtain and look behind the scenes, that colorful environment is sitting on top of this highly complex, heavily regulated financial machine.
It really is. It's a machine with a massive amount of moving parts.
Yeah.
If you're the one running it, the stakes are incredibly high. I mean, the margin for error is razor thin.
And yet, from what we're looking at today, the standard financial practices in this industry often leave operators flying completely blind for like 12 months at a time.
Yeah, which is just a terrifying way to run a business.
It is. Which brings us to the source material we are diving into today. We have an incredibly detailed advisory piece from Trinity Accounting Practice.
Right, and they specialize exclusively in childcare operations, so they really know this space.
They do, and they've laid out this really compelling argument for why childcare centers desperately need a mid-year financial integrity and compliance audit. So the mission of this deep dive is to explore those hidden financial gears. Right. We're going to uncover exactly why waiting until the end of the financial year to look at the books is just a massive, costly mistake.
It's a huge trap.
Okay, let's unpack this. I'm trying to put myself in the shoes of an operator here. Why is waiting until June such a trap? I mean, aren't these businesses just operating normally like any other local shop?
Well, to understand the trap, you really have to look at the daily, like the psychological and operational reality of a childcare operator.
Okay, what does that look like?
They are, by absolute necessity, hyper-focused on the day-to-day. I mean, they're managing strict staff-to-child ratios, dealing with anxious parent communication.
Oh, I'm sure that takes up half the day alone.
Exactly. Plus, ensuring the physical safety of dozens of toddlers and desperately trying to maintain enrollments. Because they're so entrenched in those high-stakes daily operations, the broader financial controls inevitably take a backseat.
Right. The default behavior is probably to just, keep the doors open, keep the kids safe, and let the tax accountant sort out the messy numbers at the end of the financial year.
Spot on. And, I mean, honestly, that sounds completely logical, right?
It does sound logical to me. If I'm busy running a business, keeping my customers happy and my products safe, I'm going to delegate the math for later.
It does sound logical, but it establishes the primary conflict these operators face. Because by the time that end-of-year review happens, months have passed.
Ah, I see.
And if there's a systemic error, say a miscalculation in payroll or a missed government funding claim or a recurring compliance breach, that error hasn't just sat there. It's been compounding week after week for an entire year.
Oh, wow. So by the time the accountant identifies a problem in, late July?
Thousands and thousands of dollars have already vanished. Gone.
Wait, I'm stuck on something here. Because our source calls out the illusion of the monthly report. If an operator's accountant or bookkeeper hands them a profit and loss statement like a P&L at the end of every month, why can't they trust it?
Well, that's the thing.
Isn't it literally their job to make sure those numbers are right? Why would an owner be operating in the dark if they have a monthly P&L?
What's fascinating here is the massive difference between data entry and data verification. A lot of center owners are diligent enough to look at their monthly P&L, right?
Yeah, you'd assume so.
They see a bottom line that looks healthy, and they make major management decisions based on that single number. They might decide to hire a new senior educator or buy a new commercial play structure or take a draw from the business to pay their own mortgage.
But they're relying entirely on an unverified report.
Exactly. The bookkeeping software has just categorized the money flowing in and out based on whatever rules were set up on day one. If a transaction was coded incorrectly, the P&L just blindly reflects that error.
Give me a tangible example of that. How does a miscoded transaction actually skew the reality of the business?
Let's say a center spends $30,000 on a major playground renovation. Now, that should be categorized as an asset that appreciates over time.
Right, because it's a long-term investment.
Right. But if the bookkeeper accidentally codes it as a general operating expense for that specific month, the P&L is going to show a catastrophic $30,000 loss.
Oh, no. So the owner panics.
Exactly. The owner thinks they are bleeding money, And maybe they freeze hiring or cut back on essential supplies. And conversely, if they accidentally code a $20,000 business loan as revenue,
Oh, I see where this is going. The P&L shows massive fake profit.
yes, the owner thinks they're flush with cash and makes a really risky expansion decision.
It's like relying on an unverified P&L is like driving down the highway looking at a broken speedometer.
Yeah.
You think you're cruising at the speed limit because the dial says so you feel completely safe.
Right, but underneath the hood.
Exactly. Underneath the hood, the transmission is failing, the fuel line is leaking, and you're actually doing 90 toward a brick wall. But you're about to get a massive ticket because the instrument you trust is lying to you.
That is precisely the danger. Every single management decision you make from that point forward becomes a gamble based on a hallucination.
That is terrifying.
And these foundational issues can stay hidden for years. I mean, we aren't just talking about one mislabeled invoice. The Trinity piece highlights unreconciled bank accounts, where the software's balance doesn't actually match what's in the real-world bank vault.
Which is a huge red flag.
Massive. It also points to incorrect GST treatment, where you're paying the government tax on things you shouldn't or failing to pay tax on things you should. It mentions errors in director loan accounts.
So if nobody is looking under the hood halfway through the year, you are just accumulating hidden debts.
Basically, yeah.
So if my speedometer is broken, what exactly needs to happen mid-year to fix this? The source talks about scrubbing the general ledger. For those of us who don't dream in spreadsheets, what are the actual mechanics of an integrity check?
Well, the audit has to go line by line through the very DNA of the business. You aren't looking at the final P&L number, you're testing how that number was built.
Okay.
The general ledger is basically the master diary of every single financial event in the business. Scrubbing it means verifying that every entry in that diary actually makes sense.
Got it. So it's double-checking the math.
And more than just the math. It involves deep bank reconciliations, proving that the transactions in the software perfectly mirror the actual bank statements. It means verifying accounts receivable like who actually owes you money and how old is that debt.
Right, because old debt might never get paid.
Exactly. And you have to match the asset registers to the physical equipment you own. The whole objective is to ensure the foundation is rock solid before you build your next strategy on top of it.
Okay, that paints a terrifying picture of the general numbers being a mirage. But I want to zoom in on the single largest line item on that P&L because the source material makes it very clear. This is where those hidden errors compound the absolute fastest. Staffing. The wage weight.
Oh, it is the heaviest weight by a massive margin. In the childcare industry, wages represent anywhere between 60% and 75% of a center's total expenses.
Wait, really? Up to 75%?
Yes. Just conceptualize that proportion for a second. Up to 3/4 of every single dollar going out the door is tied directly to payroll.
Which means a tiny error in payroll is never actually a tiny error.
Exactly the opposite. Because of the sheer volume, a small payroll error becomes a catastrophic multiplier.
Walk me through the mechanism of how this happens.
Okay, say you have a part-time educator, and due to a misunderstanding of the highly complex early childhood awards, the legal frameworks that dictate pay their baseline hours are misclassified.
Okay, so a simple clerical error.
Right. Maybe they're working 38 hours a week, but their profile was set up for 35. The software doesn't know to trigger the mandatory overtime rates for those extra 3 hours.
So they're being underpaid every single week.
Yes. And it might only be $30 or $40 a week, but you repeat that $40 error across 15 different employees, across biweekly pay cycles, week after week, for 6 straight months.
Oh, man, it snowballs.
Suddenly, you don't just have a minor administrative oversight. You have tens of thousands of dollars in wage theft liability. You've got compounding penalties from the Fair Work Ombudsman and a full-blown financial crisis that can literally bankrupt the center.
Yeah, that's not something you want to mess with.
Not at all. The advisory piece specifically warns about a minefield of these pitfalls. Incorrect leave accruals, missing records, and miscalculating ordinary time earnings.
Hold on, I need to play devil's advocate here for a second because we are living in the most digitally connected, automated era in human history, right? Every business uses cloud accounting now.
That's true.
So with all the modern software out there like automated timesheets, digital rostering, shouldn't this compliance essentially handle itself? I feel like I constantly see ads for software that promises to make payroll a one-click process. How are these operators still getting ordinary time earnings and superannuation wrong?
It's a totally fair assumption, and it's one that traps a lot of smart business owners. We call it the illusion of automation.
The The illusion of automation.
Yeah. If we connect this to the bigger picture, we have to remember that software is completely, ruthlessly literal. It only does exactly what it's told to do by the human who set it up.
Ah, garbage in, garbage out.
Exactly. It's a high-speed train on whatever tracks you laid. If you laid the tracks toward a cliff, the software just gets you to the disaster much faster and more efficiently.
Uh-huh. So if the initial box you checked was wrong, the software just automatically executes the wrong calculation hundreds of times perfectly.
Precisely. Let's look at ordinary time earnings,
Yeah.
which you just mentioned. This is a crucial concept because it dictates how much superannuation, which is Australia's mandatory retirement contribution, an employer has to pay.
Right.
Well, not all types of pay qualify for super. Base pay does. But certain types of overtime or specific allowances might not. If the person setting up the software accidentally checks the wrong box in the settings, the system might fail to calculate superannuation on thousands of dollars of eligible earnings.
Wow.
So the dashboard on the owner's iPad looks beautiful and perfectly balanced, but behind the scenes, they're building a massive debt to the tax office.
And the compliance burden isn't just about getting the math right for the individual employee, is it? Reading through this, it seems like childcare operators are caught in this terrifying web of obligations from multiple regulatory bodies simultaneously. It's not just one boss they answer to.
Not at all. They have the Australian Taxation Office heavily scrutinizing their PAYG, which is the tax withheld from employee paychecks, and their superannuation guarantee payment.
Yeah, that's one.
Then they have the Department of Education, overseeing strict educator-to-child ratios, which directly impacts their funding. They have Fair Work Monitoring, the award compliance we just talked about, plus various state-level regulatory authorities checking safety and qualifications.
That is dizzying.
It is. With payroll and super requirements getting stricter across the board, an automated software system is absolutely not a substitute for a human-led mid-year compliance audit. Prevention is significantly cheaper than correction, especially when regulators start levying aggressive fines for historical non-compliance.
This is a wake-up call for anyone listening who runs any kind of small business, honestly. You might not be wrangling toddlers, but if you're blindly trusting a monthly P&L export from your cloud software without doing a mid-year reconciliation, you're driving completely blind.
Absolutely.
Okay, so we've addressed the money going out, which is that massive 75% chunk of the pie. Let's pivot to the money coming in, the revenue engine. Because this source outlines an incredibly dangerous gap between what operators call profit and the actual physical cash sitting in the bank.
Yes. This gap is the difference between accounting theory and operational survival.
How so?
Well, for the vast majority of childcare centers, their largest single source of income isn't the out-of-pocket fees paid directly by parents. It is the Childcare Subsidy, or CCS.
Right, government funding.
Exactly. This is government revenue designed to offset the cost of care for families. But because it is government money, the reporting requirements are incredibly rigid.
Explain the mechanism there. How does the CCS actually trip up an operator financially?
It often comes down to discrepancies between the real world and the government's portal. Let's say a parent is stuck in traffic and picks their child up 15 minutes late.
Okay, happens all the time.
Right. The child is safe, the staff accommodated them, no big deal in the real world. But the center's software has to perfectly sync that real-world attendance variation with the government's strict session booking system.
Oh, I see.
If the data submitted for the CCS claim has a mismatch, like if the times don't align perfectly with the agreed-upon session structure, the government system automatically rejects or suspends the subsidy claim.
Just like that.
Instantly.
Yeah.
The center is out hundreds or thousands of dollars for services they already provided.
Here's where it gets really interesting, because this connects directly to the stark warning in the document. Profit does not always equal cash.
That's a crucial distinction.
Right, because an operator can look at their P&L and say, wow, we invoiced for $100,000 of care this month. We're making a fortune. The P&L says they are wildly profitable. But if the government delays a $40,000 CCS payment due to a tiny reporting mismatch, they don't actually have that money.
Exactly. The money isn't in the bank.
I like to think of it this way. It's like running a popular restaurant where everyone pays with gift cards they bought last year. The dining room is completely full, people are eating, having a great time, you look incredibly profitable today. But if you open the cash register, it's totally empty, and your food supplier is waiting out back for his payment right now. Profit is the weather forecast saying it'll be a nice week. Cash flow is whether you actually have an umbrella in your hand when it randomly pours today.
That restaurant analogy is perfect because it highlights the immediate crisis. You can have a fantastic, profitable month on paper, but you still owe your staff their wages on Thursday.
Yeah, they don't care about the P&L. They want their paycheck.
Exactly. You still owe rent on the first of the month. You still have to remit the PAJU taxes. If families are late paying their gap fees or the CCS is delayed, your bank account might only have $10,000 in it when you owe $50,000.
Which is terrifying.
It is a devastating cash flow crisis, completely masked by a profitable P&L.
So how does a mid-year audit actually solve that? How do you audit cash flow to make sure your cash register isn't empty when the supplier shows up?
Well, the mid-year review shifts the focus entirely. It moves away from what you've theoretically earned and zeroes in on what you actually hold and what you owe right now.
Okay, getting practical.
The audit examines current liquid cash reserves. It forecasts upcoming liabilities. So it looks ahead and says, okay, the massive quarterly superannuation bill is going to hit in 4 weeks, and the tax office needs their PAYG payment in 2 weeks.
This is like a financial calendar.
Very much so.
Oh.
It examines current debt levels, expected enrollment trends for the next 6 months, locked-in payroll commitments, and any required capital expenditures. Like knowing the commercial fridge in the kitchen is dying and will cost $8,000 to replace next month.
Right.
By analyzing all of these factors together mid-year, management can actually see the cash flow cliff before they drive over it. They can secure a line of credit or adjust their spending now, rather than experiencing sheer panic when a bill is suddenly due.
All right, let's step back because I feel like we've spent the last few minutes frantically patching holes in a sinking ship.
It can definitely feel that way.
We've talked about stopping the leaks, making sure the staff are paid legally, avoiding a compliance disaster with the regulators, and making sure we don't run out of cash. That is all defense. That is purely about survival.
Right.
But how do we use this data to actually go on the offense? If I fix the leaks, how do I actually use these numbers to grow the business?
This is exactly where a stressful compliance exercise transforms into a massive strategic advantage.
Yeah.
An audit shouldn't just be a forensic search for problems. It is fundamentally about spotting hidden opportunities.
Okay, I like the sound of that.
The reality of the childcare industry, and really most small businesses, is that owners operate in a complete silo. They know their own daily struggles, they know their own bank balance, but they have absolutely no idea how their center's performance stacks up against industry averages.
Because they're so focused on their own four walls.
Exactly. Benchmarking pulls back the curtain on the wider industry. It takes your verified data you can finally trust because you just completed the mid-year audit, and compares it to the key performance indicators that dictate success across the sector.
What kind of metrics are we talking about here?
We're looking at metrics like average occupancy rates. We're looking at staffing costs as a percentage of revenue. Like, are you operating efficiently at 60% or are you dangerously bleeding out at 80%? It examines net profit margins, administration costs, and crucially, revenue per child versus revenue per room.
Let me challenge that for a second. Does benchmarking actually lead to actionable change on the ground? Or is it just a fancy corporate report card that makes a hardworking owner feel bad about their high admin costs? I mean, does a metric like revenue per room actually move the needle for a small business?
Oh, it absolutely moves the needle because it completely removes the guesswork from management decisions.
Give me an example.
Let's look at that specific metric. Revenue per room. Let's say your benchmarking report shows that your nursery room is running at 95% occupancy, which sounds amazing, right?
It sounds like you're killing it.
But the revenue generated from that room is 8% lower than the industry average. That incredibly specific data point tells you immediately that your session structures, your daily fee rates, or your CCS optimization strategies are fundamentally misaligned.
Ah, so you're full, but you're leaving money on the table because of how you structured the billing.
Precisely. Armed with that knowledge, you can make a tiny operational tweak, adjusting the session hours slightly, or revising the fee schedule for the new year.
Right.
Because your fixed costs for that room remain the exact same, that tiny revenue tweak drops straight to your bottom line as pure profit. Furthermore, this level of verified benchmark data is the absolute prerequisite for strategic growth. Well, if you want to add an extension to the building, acquire a second childcare business, or refinance your existing commercial debt for better interest rates, banks and lenders will not just take your word for it. They demand this exact level of verified, benchmarked financial data.
Which really highlights why the team at Trinity Accounting Practice put this advisory piece together in the first place. When you read through their methodology, it becomes obvious that you cannot just take a business this complex to a generic neighborhood tax accountant who does your personal returns once a year.
No, the ecosystem is far too specialized. The source material emphasizes that effective mid-year audits require practical experience in actual childcare ownership and operations.
Yeah, that makes sense.
An auditor has to intuitively understand educator ratios, they have to navigate the bizarre complexities of the childcare subsidy, and they need to be experts in the specific niche software platforms these centers run on.
Yeah. The piece specifically mentions their focus on executing massive zero cleanups, conducting deep dive due diligence for business acquisitions, and providing profitability assessments that actually make sense to operators. They aren't interested in generating complicated, jargon-filled reports that just sit on a shelf gathering dust.
Right, they're focused on practical, immediate recommendations.
So what does this all mean for you? Whether you are heavily involved in the early education space, or you're just someone who finds the hidden mechanics of business operations fascinating, the core lesson here is universal. A mid-year financial integrity audit is the ultimate diagnostic tool.
It really is.
Finding these hidden structural issues halfway through the year gives you the one crucial commodity that business owners never have enough of: time. It gives you the time to fix a compounding payroll leak, the time to adjust a dangerous compliance error, and the time to secure your cash flow before it destroys your profitability or your overall business value by the time June rolls around.
This raises an important question about the fundamental mindset of business ownership. What we're really talking about today is the shift from being a reactive operator, someone who just exhausts themselves, putting out daily operational fires as they appear, to becoming a strategic owner who uses verified, stress-tested data to dictate their own future.
Yeah.
You simply cannot optimize a business if you don't actually know with absolute certainty what's happening underneath the hood.
It completely reframes how you look at a business. It's not just about the product, it's about the plumbing. And it leaves me with a final thought for you to ponder as you go about your day. If a seemingly straightforward, wholesome business like a local childcare center holds this staggering level of hidden financial complexity, compliance danger, and systemic risk right beneath the surface.
Really makes you think.
It does. What other predictable businesses in your everyday life are actually operating on a complete illusion of data? What other industries out there, maybe even the one you work in, are desperately in need of their own mid-year deep dive? Thank you so much for joining us as we unpacked the hidden financial machinery of childcare. We'll see you next time.